Nervous about the volatility of public markets? Looking to invest in Canadian real estate but not finding the right opportunities? Neighborhood Holdings may be an option. Nearly 10 years of consistent performance, Neighborhood aims to provide stable income while preserving invested capital, target net yield above 8%. At the heart of the strategy is Neighborhood's mortgage product portfolio of first position 100% residential mortgages across Canada with an average loan to value under 55%. Neighborhood partners with mortgage brokers and financial institutions to support quality borrowers in transition who may not currently qualify for traditional financing and have a temporary need for capital. Neighborhood's portfolio has no exposure to commercial, construction, or bare land properties, is geographically diversified across major urban and suburban centers in Canada. Check out the links in the description or visit neighborhoodholdings.com to view the offering memorandum for investors and advisors or to explore mortgage broker partnership opportunities. This is not advice. Please consult a professional advisor before investing a loonie in any of these investments. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to Loonie Hour, episode 195. As always, joined by the three amigos. We've got the Boomer over in Halifax, Rich Diaz in Montreal. Welcome back to the show, gentlemen. Richard.
What's up? What's up? Canadians are going to win the Stanley Cup. You heard it here first, folks. We signed
Jesus. It's July, and he's still talking about the Montreal Canadiens.
A right-handed puck-moving defenseman. Okay. No, I'm kidding.
No adoption.
Loonie Hour community, please make him stop. Please.
They've you know what, Rich? I'll give you some credit. The Habs have made some good trades, couple signings.
Anyways. No, I'm just teasing. There's so much good stuff to talk about. I don't want to talk about hockey. There's so much good stuff. There's Germany.
I told you, free agent frenzy is my favorite day of the year. This year was very
Happy Canada Day, everybody. Happy Canada Day. This is a great country still.
All you Leafs fans out there, Marner's gone. Suck on that. All right. Now we've lost half the audience. Yeah. Let's get into it.
How you doing, Keith?
Nobody asked. Thank you, Rich. No one asked me. Steve doesn't care anymore, right? He doesn't care about
How are the Mooseheads doing?
I don't know. I went to a movie this week with Junior. Yeah.
What movie?
So we saw 28 Years Later. I love
I want to see that. Is it good?
I love the zombie genre. Yeah. Well, yeah, it was if you're into that world, it was good. It was
I heard it's pretty intense.
In one. Yeah, it's a bit stressful for a while. But that's the first movie I've seen in a theater since, oh my God.
1982.
Yeah, like Porky's, I think, was the last thing I've seen.
It's a great film, by the way.
Yeah, it was fun. Anyway, it was good. It was like $85 to see the movie. And it was fun. But
honestly, that's like I don't know. I know we talk a lot about finance. I don't know how that company's still in business. They're publicly traded, aren't they?
Which one?
Cineplex.
Oh, I don't know. Yeah, I guess so.
We don't mention specific companies here.
That's right, Steve. Come on, you know that.
Regulations.
That's
Anyways.
Right. There were 8 people in the theater watching.
Yeah, well, that's
now, mind you, we did go to the matinee because I can't stay up late. So
brother.
Yeah, it was one of those. Okay, Steve, line us up for the week. Hey, this is exciting for the summer week.
Great week. Post Canada, dog days of summer, but
we thought it was going to be a slow week. All of a sudden, Rich woke up like on fire this morning. He's
blowing
ready
up the
to
group
go.
Chat.
Yeah,
I got a little bit of real estate info to touch on. Obviously, that's all I can provide. Digital services tax. We've got some issues that are developing in the UK, Germany's natural gas. Lots going on in the energy markets. U.S. jobs data out today. So obviously, and some recent comments. I think big picture of the U.S. administration, what Trump is trying to do. Or has said he's going to do. And I think that has major implications for financial markets moving forward over the next 12 months. I think, Keith, I think we chatted a little bit about it at Ben's cabin there for the future direction, but we'll kind of get into that later in the show. We're here in early July now, so we got some real estate data
for the month of June. I only have the Vancouver data. I don't have the Toronto. I guess they haven't released. There's Treb. The Treb guys are still on vacation. But if you're following the housing market and looking to sort of understand what's happening, Vancouver and Toronto pretty much are identical in terms of market activity. So I can give you the Vancouver housing data. Home sales throughout the region were the lowest in 20 years outside of June 2019. So if you go back and look at the historical months of June data, slowest June in 20 years outside of June 2019. And then you had new listings, I believe we're at a 20-year high. Anyways, the new listings were highest ever for the condo market. So, we've talked about that theme on this podcast quite a bit, which is most of the issue, most of the pain is concentrated in that condo segment because the investors have basically fled, right? You've had that 20-year bull market, which has encouraged a lot of capital, a lot of malinvestment into that condo space. Everybody trying to build out a portfolio of, 5 condos and a house. And what we've seen, obviously, with rates going from 0 to 5%, is of course the investors are fleeing the market. So the rush of them sort of trying to exit the market is showing us that new listings in the condo space are all-time record highs. Which we contrast that to, let's say, single family houses. New listings are still running at well below the 20-year average. So again, in these major cities such as Vancouver, Toronto, you're just not really building new single family housing. You're not really seeing an increase in inventory in those spaces. You've got some accumulation on the resale market, but in general, I think it's important to contrast those two, which kind of leads into the development space, which we can touch on as well.
Steve, I have a question for you. A bit switching gears tiny bit, but related to real estate and related to investment. I read a lot of people commenting that it's because investors are so involved in the real estate market that affordability has taken such a big beating. Can you address that claim that, if it wasn't for the big bad corporates and mean investors, that affordability in Canada's housing would be affordable? Can you confirm or deny that? Is it?
Yeah, I understand the argument. I just had a debate the other day with John Passalis, who's the Toronto guy, always on Bloomberg there, and that's like, I think investors are more a symptom rather than the cause, which is to say that, like, when you have, Keith would appreciate this, right? When you have a 20-year bull market and every year home prices go up and the government seemingly has your back, which is like, hey, listen, the housing market's too big to fail. So every time it wobbles, we kind of step in and sort of try to massage it. It sort of incentivizes capital to go into that space, incentivizes investors to take on more risk. When you lower interest rates to 0, you tell Canadians, hey, listen, go and borrow money because we're never going to raise rates again. It incentivizes that behavior. And so I think that created the investor base. Now it's kind of a two-step problem because, and this actually leads to another conversation, which is in Canada, the new construction model, the way our capital markets are effectively structured in Canada, the only way to build like new construction is it requires money, right? It requires capital. And the model is the banks say you need to pre-sell 60 to 70% of your units in order for us to give you a construction loan. And so the developer then has to go and say, okay, well, who wants to tie up their money for the next 5 years while we build this project? Is it going to be the end user? Is it going to be the first time home buyer? Or is it going to be an investor? I would argue that it's the investor, because most end users, most first time home buyers don't want to buy a piece of paper. They want to move in next month. They want to walk through the unit. They want to check out the finishings. They want to know what the floor plan feels like. And so the only people that are seemingly willing to take on that risk is the investor base. So the investor base is ultimately what funds the cost of new construction. They are the capital provider.
Okay. I mean, that makes sense. I guess, again, a slight little question then is like, but investors in general, other than a couple of jurisdictions in Vancouver, they don't keep the houses empty. Like the housing stock, just because an investor owns a piece of the housing stock, that people can still live in and utilize that home, right? Or apartment or etc.
I mean,
Or
I think there's
am I wrong about that?
well,
Sorry.
there's definitely like a bunch of empty units. I don't
Yeah.
think it's as pervasive as people make it up to be, but I think there's definitely certain neighborhoods, especially in Vancouver, where you have a lot of overseas owners that are here to park their offshore wealth. It's a safe haven, right? I mean, if you're facing a communist government in China, you probably want to
I
get
thought you I thought you were going to say Ottawa for a second.
touche.
Come on.
You know, you probably want to get your money out though, right? It's like, why wouldn't you? They're doing the rational thing, which is like, I need a safety valve, and I'm going to have some money parked in Canada, which is a safe jurisdiction. So
Right. But let's not get down too far down that rabbit hole. The point is, my point is, in general, most investor housing stock is being utilized because they're generating yield off that. No.
yeah, yes, correct.
Okay.
In my opinion, like, and you know, the idea, there's a lot of people out there that mistakenly think that Canada is like the US, which is like you have Wall Street coming up and buying single family houses.
Thousands.
That does not happen. Does not happen in Canada. Like, no one's coming into Vancouver and Toronto buying like an old crappy 80-year-old house for $2 million and renting it out for $5,500. Like, it just doesn't make sense. What they do in the States is they go out and buy like massive swaths of cookie cutter houses for $350,000 that rent for $2,000. And you know, these massive subdivisions are all the same, so they have some scale there. There's no scale of where the corporations are involved in Canada. It's like these pension funds or these REITs that are going up, and they're actually often developing new apartment buildings, and then they'll own the entire apartment building, which is a purpose-built rental apartment building. So,
Which is full of people, right?
which is full of people. So yeah, I think
okay.
I think ultimately it gets villainized. Yes, obviously when you have more investors, more people chasing or competing for housing, it will drive the prices up. I think that's ultimately a function of way too much immigration that is a mismatch between your ability to deliver new housing, and you know, what, 15, 20 years basically now of like negative real interest rates. So I think that's the biggest issue.
Yeah, to go back, so Rich, your initial original question, just so I can, just to square it back here. It seems like a lot of people in Canada, they were frustrated with housing, and they want to say, well, why can't we afford something? So they have to find someone to blame.
Yeah.
And the blame is that the institutional world has come in, and that's caused affordability to deteriorate. Right? That's the gist of it. And Steve, your response to it on the moving aside from single family dwellings, like the dude or the small corp who's going to build condos and pre-sell them, your answer was 100%. It was perfect. They need liquidity, they need credit to build it. First time homeowners, most of them aren't willing to do that because they want to see what they're buying and so forth. So Steve's answer was perfect. This is the way the system works. And really, I think if people have a frustration with not having an affordable home, I mean, this is me. It's really just based on, again, all these challenges today, they're symptoms of the bigger problem.
Yeah.
And the problem that we have is this population growth story. Everything comes back to that incredibly significant bad policy decision that the country made. So not enough housing, not enough healthcare, infrastructure is poor, classrooms are overcrowded, taxes are going up, you're getting less for
it's all the same, right? Yeah, Keith, you look at like Western civilization, Western democracies, right? And it's like the same conversations are, like Canadian housing looks dramatically worse than the US, but if you look at the US, they're having the same problems. Oh, the youth can't afford housing. The median age of a US home buyer now is 58 years old. The median age of a first-time home buyer in the United States is 38. So it's gone up dramatically. So it's the same story. Australia, New Zealand, Rich, UK, like the youth can't afford housing. I think it's also, Keith, the bigger picture is this has been a stealth debasement over the last 20 years, right? I mean, the reality is the currencies that you earn income in does not go as far as it used to, right? You you used to be able to buy a house on a single income, and the wife could stay home with the 4 kids, and you'd own a house at 23
Yeah,
years
now we're
old.
going back to, and you guys tend to roll your eyes at me when I'll say this one. And when I say that, you guys are thinking, okay, which 5 things is Keith going to say? Is it this one, that one, or that one? But if we had different policy reactions during the COVID pandemic,
Agreed.
I bet you the aggregate inflation story today is probably 10% of what it currently is.
Yeah, I agree.
So you go back to that.
Oh, my favorite chart. My favorite chart.
We're back
still
to
is-
front running again.
Well, if you take any home price chart, whether it be Vancouver, Toronto, Canada's national home price index, and you denominate that in ounces of gold, I think it tells you an interesting story, which is to say that home prices in Canada effectively peaked in 2007, which flies in the face of any you know what I mean? Like, if you told that to anyone, they would, no way, right? I mean, all home prices have done since 2007 is move higher.
But it's related to your negative real interest rate thing. And so
Yeah,
I didn't
I
mean
think
to
it's
take us
just-
down this long road, but I just like the negative real interest rate, which means that your interest rate is lower than inflation, which means in effect, you can borrow for free. You get paid to borrow, and show me an incentive and I'll show you a result.
So that takes us, I think, Keith, to the next sort of segue here, which is where do we go from here? I think there's been some interesting comments out of the Trump administration over the past, call it, a week or two, which is, when he was elected and Elon Musk was there, it's all about like Doge, we're going to cut the deficit, we're going to find all of these savings, and we're going to basically work on balancing the budget. Since then, Elon Musk has effectively been turfed. Doge has really not been a success at all. And the Trump has come out along with Treasury Secretary Scott Bessent saying, we're going to basically have to grow our way out of this now. We're going to run a very pro-growth policy. Agree with that or disagree with it? That's what they're telling you. We're going to run a pro-growth policy, and we're going to effectively, they're telling you, we are going to run this economy hot. We're going to have GDP grow faster than the debt. And so, debt to GDP will come down. So, like, effectively, Rich, and we know that Trump has been lobbying for Powell to cut rates. We need to get rates down. We need to get rates down, and we need to basically pump the hell out of this economy. And this is, effectively what he's saying is like, we are going to debase the debt. Yeah. Nominal GDP is going to.
I know
higher.
Keith wants to get there, but
Keith,
I'll just say
in there.
best laid plans, right? Hey, Keith.
So, Scott, I want to read some comments from Scott.
Itching to get in. It's just where we're going. I'm going to the summer club soon in another hour, so that's where I'm going to go.
I want to read some comments from Scott Bessent. He says, quote, we are going to grow the GDP faster than the debt growth, and that will stabilize the debt to GDP, which is the most important number. We're getting spending under control. Then through POTUS's trade policies, tax policies, and deregulation policies, we're going to grow faster. We're going to grow the GDP and shrink the growth of the debt. And that completely changes the trajectory. So effectively, we are going to grow the GDP faster than the debt growth, and that will stabilize debt to GDP, which is the most important number.
Party on.
That's from Scott Bessent, your Treasury Secretary, who, of course, he cut his teeth on Wall Street. He is, a respected name on Wall Street.
It's really interesting because no one has tried this before, Rick. This is a brilliant policy move by.
It actually sounds like Christopher Freeland, by the way.
I do.
No, not you. Scott Bessent sounds a little bit like Christopher Freeland. But sorry, I interrupted you.
You tend to, as an investment manager, you never say what are policymakers, what should they do? Instead, what are they going to do? And this is policies that the Americans are going to do. I'm going to tell you they're identical to what the Canadians are going to do, and Rich is going to tell us what the Germans are going to do coming up, and the Brits are doing the British thing. Rich will describe that with his British accent, I think. But of course, we have a debt problem around the world. For anyone to disagree with that, you belong on another world, on a different planet. That's where you have to go. So because they can't get debt under control, and the only way to do that is to borrow less. It's pretty simple. Households, we will borrow less because we have to pay the piper, if we can't pay back debt. Governments are able to do a lot of, magical things to push the envelope out. And so for the Americans right now, they're saying, yeah, we're going to have this big, beautiful bill. We're going to spend, spend, spend. We're going to attract foreign investment. And again, they're crystal clear with this. Like they want to attract foreign investments for the energy sector, for the technologies sector, and any other sector they can grab money on. And other countries will try to counter it. But if you look at the US now, I think we were looking at somewhere before we went on the air, guys. I think there's about 12 trillion in treasuries maturing in the next 12 months. I think the number is.
Something.
So
huge,
all this talk about, Trump is saying, hey, I want the Fed to start cutting rates. They should cut rates. And, it's kind of funny to watch all this play out. But right now, the American overnight rate is 4.25%. And, Washington is comparing this to other central banks, including Canada, where we're just say it's 2.25%, 2.5. So we're saying, hey, we have 200 basis points that we can chop off here. So Loonie Hour math, everyone. If we take 2% of 11 trillion, how much is that?
I don't know.
Let's just call it 300 billion. Right?
Okay.
In that range. So one way to get your budget temporarily under control is to control the amount of money that you're spending on interest expense. So back in the early 2000s or late 90s, when Bill Clinton was in the White House, I don't know if you remember, back then they balanced the budget.
Mm-hmm. Amazing.
And it was
impossible to believe.
Yeah, it's amazing. Yeah, it was amazing, absolutely. But one of the main things they did, though, that they shifted all the debt to short term.
There was also there was a lot of growth as well, to be fair.
You want to dumb that down for the audience, Keith?
Yeah, so let's just look at it from a mortgage interest rate perspective. Let's just say, Steve, what is the 10-year mortgage rate if you were able to get one? 5?
You can get them in Canada. Nobody really borrows at the 10-year. I would guess, I don't know, because that's not a market that I follow, but I'd say your 5-year today is, call it 4.2. So your 10-year would probably call it 5.2, 5%, 5.2.
Okay, 5.2. So let's just say you have a $1 million mortgage and you're borrowing at 5.2, and all of a sudden you're able to move that down to say a 2% rate. So now it's 3%. So that's basically 30 grand a year less you're spending on interest. And that's $30,000 more you have in your pocket. That's the exact same thing of what the Americans want to do now with their debt structure. Instead of paying out 4% on debt that's rolling over, I want to pay out 2%. But they can only pay out 2% if the Fed cuts rates from 4% down to 2%. And that's what's happening right now. And then of course, say, hey, we're going to grow faster. But we share this narrative a lot. The world had zero rates and negative rates from, call it 2010 to 2022, maybe. Is that when rates started going up?
22. Yeah, 12 years.
Yeah, so let's just round it to 15 years, because it was really like 08, really, when rates hit 08 and 09, when rates hit zero. So 15 years with rates at zero, governments borrowing everything they could, and they still couldn't grow faster than what the debt was growing for everyone, right? Mm-hmm. And that's at a period when rates were zero; they weren't even going up. Now we're at an experience where, rates are higher than they were. Everyone has a higher interest rate now than even the Japanese. What are they now, Rich? A quarter point? And they were at zero, right? So it's still
50 basis points, Keith. 50 basis points.
Which is a lot more than zero. So 50 divided by zero gives you the, the illogical function on your spreadsheet. But again, if this strategy didn't work when the whole world they could borrow for free, how is it going to work now when they have to borrow anywhere from 2% and higher? And plus, the only way to create growth is by borrowing. There's like that whole productivity story. Yeah, maybe they'll get it through technology and things like that. But I just think it's going to be very, very difficult. But that's what this. So when you hear Trump now saying, "Hey, I want a new chair of the Fed who's going to cut rates," it was kind of funny because this past week, everyone is jumping out of the woodwork. If I was Fed chair, I'd cut rates. Yeah, if I was Fed chair, I'd cut rates by 200 basis points. And, it's just kind of funny, but that's what they're doing right now. And it doesn't matter, again, yeah, it doesn't matter where you agree or disagree with what Trump is saying on this. Instead, you have to say, this is what he's going to do. So really, the Fed is still going to be the Fed. I think Powell is in until April or May of next year.
Yeah, I thought it was May, but yeah.
Yeah, and if the economic data is weakening, then he'll have the reason to cut rates, which we'll go into in a few minutes, because it doesn't look like that's happening slightly.
Well, yeah. So on, but like, what are the markets currently pricing in, right? I mean, Keith, we talked about this just before we jumped on the call, but what the markets are pricing in, 150 basis points of cuts over the next 12 months?
I don't have that screen up front, but I know,
can get
for example, like on Wall Street, I think Morgan Stanley came out with one. I think they're projecting 150 or 175. What was their number for cuts?
So right now the market's projecting 100 basis points between now and next summer.
Would you know when those cuts are like? Are they backloaded to say like, hey, Powell's going to be out in whatever April or May? So like.
Sorry, I screwed up. It's 120. It's about 120 basis points between now and August of next year, and they're front loaded. It's all between. So after August, this is according to the CBOT like futures curve, right? So these can change, and they do change regularly. This is a way that people can bet on the future path of interest rates, and they can extract probability distributions from these markets. It's not unreasonable. Every basically country can do this, or has some way of doing this. But just so you understand, so in the next 12 months or so, there's 120 odd basis points of cuts being priced in, and then afterwards the yield curve is flat. That is to say that there are no cuts after that being priced in. The problem with that is that it's the further out you go, the less reliable it is with respect to the expectations. So you can't read too much into that. Nevertheless, that is what the data said.
Now the first cut's expected for September, correct?
Yeah.
But I guess, the pushback on that is that the market's been begging the Fed for cuts for the last 12 plus months, right? I mean, they've always have had to revise their projections or forecasts down, which is to say, hey, we were thinking 6, but now it's turning into 5, into 4, into 3.
That's true.
I would expect.
Okay, go ahead. Sorry.
Yeah, I would because remember we had these conversations at beginning. It was the beginning of the year, right? Remember the expectations, and everything got turned around. The expectations today. So if everyone understands well, we have this. Now we used to have a divergence, which that means going away from each other. Everyone, we actually had this conversation a few minutes ago. Rich was trying to get them, converging and diverging. But before, the interest rate differential between the Americans and everyone else was getting wider and wider. That's what happened, and that created dollar strength, of course. Mm-hmm. And now all of a sudden, we've done a 180, and the expectation is for almost all other central banks to either not cut rates anymore, or they have very few cuts left to go, and for the Americans to be very aggressive, cutting rates down to everyone else. It's our expectations now. This is that maximum expectation.
What?
So probably, do you know what I mean?
Can you repeat that in a way that someone understands?
So right now, if the market is expecting the Fed to cut by 150 basis points over the next 12 months, the market is also expecting the rest of the world may cut by only 0.25, as an example. Mm-hmm. So that 100 basis points difference, that is unlikely to get any bigger. That is the maximum difference. And in all likelihood, maybe the Americans do cut by 125 over the next 12 months. But if the Americans are going from 4.25 down to say 3 or 2.5, I would expect the Canadians, Europeans, everyone else, they've also cut by another 100 during that experience as well. Because the Americans are cut by that much, it means either the economy is not doing very well. I don't think that's going to happen, because if you have that much fiscal policy coming in, it's going to stimulate growth in the economy. Or inflation, is come down dramatically. So again, it's going to be a very, I just don't think this expected scenario was going to play out. So 12 months from now, or even 6 months from now, we'll have a completely different perspective of what expectations.
This episode is brought to you by Square One. I recently tried them out myself. Getting a quote took less than 5 minutes, and the whole process was smooth and painless. What stood out most was how customizable everything is. Most home insurance policies bundle in coverage for things like jewelry or expensive artwork, whether you own them or not. With Square One, you only pay to insure what you actually have, so you're not overpaying for stuff you don't own. Plans start at just $15 a month, and you can manage everything. Quotes, policies, claims, entirely online or through their app. Head to squareone.ca/Loonie Hour and get a $20 account credit. That's squareone.ca/Loonie Hour.
So we kind of recap this because I think we've been talking about this has been like the theme of the show for, a month or so now, which is like this fiscal bazooka, right? Is you've got the US that is, the president is dying for further easing, has said we're going to have to grow the economy hot. We're going to have to grow GDP. You've already had every other country sort of easing policy. We know what's happening here in Canada with Mark Carney, who, can't even put out a budget forecast, right? It just says, listen, we're going to change the books. We're going to have an operating budget and a capital budget. And, the deficits, at least prior to the election, were larger than Trudeau's. So like it's every government is basically sort of loading up for this massive sort of fiscal spending side. And then you have the world's largest central bank, which essentially could be co-opted by the president of the United States, which he's going to handpick whoever he wants, next spring to come in and run loose monetary policy. So I don't know, Keith, I'm kind of curious your thoughts, but when you look at all of that, you go, that seems very bullish for risk assets.
I think what's going to happen here is, remember, policymakers have two levers. They have the spending, borrowing lever, and they've, boom, they hit it to a max. They're going to borrow as much as they can. And then the other lever, what is that, Steve?
The interest rate lever.
That's right, baby. And they're going to pull back on that to, cut rates. Am I doing that right? Is that
Maybe.
I think you pushed both of them forward, no?
Yeah.
Okay, whatever. You know what I mean. But that's the only two policy moves that governments have. They could cut your taxes. However, if that happens, it's minuscule. Like, it's not a big change. So when they do that, what happens to deficits for everyone?
They get bigger.
Yeah, they get bigger. A little bit bigger?
A lot bigger.
Probably a lot bigger.
Keith,
so
unless
it's our
you can
expectation
get the growth to run faster than the spending.
Then you probably have inflation hot as well, then, right? At the same time. So it's our expectation as this is going, and if it's, it won't all be announced in the same day around the world, but I bet you when all the lads got together in Kananaskis there a few weeks back for the G7, and then they got together in Europe for the NATO plus, it's the same people, guys. It's always the same people getting together. They've all coordinated what they're going to do. So if all of a sudden you're putting a lot of stimulus into the economy, the market, in theory, that's pretty good for risky assets, which will be equities. Like, absolutely. Mm-hmm. Also for the commodity world, more demand, and because supply is inelastic for most commodities. However, though, if you have a deteriorating deficit, more bond issuance, inflation running hot, and policymakers saying, "Oh, we don't give a shit. We're going to keep," remember, you got both levels, both levers, straightforward. The potential for someone's bond market to blow up has now gone up significantly. And if it does happen, it's going to make someone cry.
Oh, what a good segue.
What
Rich.
a segue.
Take it away.
Why? What do you mean by that, Rich?
Well, we shouldn't make fun of people crying. That's not nice from the Loonie Hour. But
but before into that though, does that make sense though, Steve, for everyone listening here?
100%.
Yeah. So again, you could have this. Wow, equities could be amazing, but we could have another market which is significantly bigger.
Can I just chime in before we get to that point, Keith? I think that, to me, not necessarily being the expert here, but that seems like the logical conclusion that you would draw, which is to say, okay, there's no real path to actually fix any of these deficits, but the pain of taking your foot off the gas is simply too much. The system is what it is, so they're going to push these
political
things.
pain. Sorry to interrupt you, Stephen,
Yeah,
but
political pain.
It's political pain, yeah. Sorry.
But in Canada, we're already behind. If the population number that we discussed a couple of weeks ago was basically flatlined for Q1, and if it stays that way, with kind of a muted growth number for the rest of the year, the only way possible for the Canadian economy to grow is it has to be an enormous fiscal bazooka.
Yeah,
it doesn't work otherwise. Yes, Rich.
Unless
the nerdy kid in the front row has his hand up.
Unless there's productivity growth.
You're not going to get that much in 6 months.
No, you don't. No, you don't.
Okay, so to Keith's point, right? It's like, okay, well, if you're going to run all these massive deficits and you're going to cut rates, you probably would have some inflation, and you'd probably have the bond market, throwing a temper tantrum.
A fit. Yep.
So the logical conclusion, the next step, what you would have to imagine would be governments coming in and engineering some sort of financial repression, which is, we've already seen Christopher Freeland talk about this, to say pension funds must own, more Canadian assets. Maybe it's, hey, pensions, you're now mandated to have a larger allocation to government debt, or, banks have to have a larger, holding of government assets, because I mean, someone's got to buy it. Someone has to buy it. Maybe it's the central bank that has to buy it, or maybe it's these institutions that get mandated through legislation. But it doesn't seem like it's going to be the private sector that's going to want to buy it.
I think it'll be so if we go down this path that we're discussing here, fiscal bazooka, everyone's borrowing crazy, stimulus flowing in, inflation is going crazy again, and then the bond market has an awkward moment. Someone cries. That's not a smooth transition to the next day. So I suspect it won't be long enough, Steve, for policymakers to mandate institutional money to buy a certain market. Right. I think you're just going to see the central bank just have to rush in and bail out the bond market. And when that's happening, then you get like the snap, crackle, pop stuff happening. And then all of a sudden, all this stimulus and markets will say, oh, what's going on here? And then you got to, it's one of these holy smokes moments. So again, we're laying out a scenario that could be incredibly positive for the economy and risk markets. However, somewhere along that path, something is going to snap in two, which is, and this is something that we've been sharing a long time. People that know us, we are headed towards this. In my mind, it's a very obvious expectation. It's the crisis, the next crisis, because where we have a crisis, financial markets, it's not the stock market. The stock market is always going to do stock market things. It's going to be the bond market and credit markets. And boy, when Rich is going to jump into this scenario here very quickly, but we're literally, just a day away from someone's bond market literally snapping in two. And that's what we have set up here.
Keith, it's already started, right? So we're like, so we're keeping score at home. It's like, it happened with the Japanese bond market earlier this year. You had an increase in the 30-year bond yield. Remember, these are long duration assets. We hit 3.25. Now we're back to 2.89, but we're well above what we've been for the last 2-3 years, and we're still at basically 30-year highs. And of course, that brings us to what's happening in the UK. And remember, folks, like the UK and Canada actually suffer many of the same issues.
British accent, please.
I can't do it. Top of the morning, governor. Anyways, but yeah, so the UK had huge population growth, unaffordable housing, lots of debt. And you've got weak productivity growth, flat GDP per capita. And now you have what was sort of a rejection of the old pseudo-conservative party. I think they were conservative in name only. Now you've got the Labour Party, and you had Rachel Reeves, who took over as finance minister. Remember, she lied, not allegedly, she lied on her CV about her working at as a Bank of England economist, only for it to be discovered that she basically worked at back office jobs. And yesterday, she sort of they've been exposed. So the Labour Party has been trying to rein in budget deficits. They want everything. They want to raise taxes, they want to spend more money, but they also want to reduce the spending. So it's sort of all over the shop. And what we've seen over the last, let's say, 48 hours has been the Labour Party tried to reduce, there's lots of things going on, but just the overarching theme was that they wanted to cut disability benefits or lower disability benefits. But there was a revolt from the Labour Party. So lots of left-wing backbenchers sort of were unwilling to accept these terms. And Rachel Reeves was basically caught. So there had to be a climb down from Keir Starmer, who's the Prime Minister of the UK, and his lieutenant, Rachel Reeves, is the finance minister. Basically, her plan has been left in shambles. The bond market was not too happy about it. And the narrative really is that, the bond market did not take the finance minister, who sits in the front benches of the parliament. Unlike in Canadian parliament, where they're all sort of spread out, in the UK parliament, they're all squished together. And the finance minister, the defense minister, and let's say the attorney general, they're all together in the front row, right? These benches were built, 500 years ago. And so when you're doing question period and you have the prime minister, defending his budget, et cetera, you cannot help but see on the screen the finance minister, whatever. And so Rachel Reeves basically started crying. Now she's obviously under a lot of pressure. And, she was basically, her plan was sold out by her very, in my view, very weak prime minister. And so the bond market and the news media and the UK newspapers are brutal. And so, they basically said that the bond market was selling off because Rachel Reeves was crying. Now I shouldn't laugh, but it is funny. And it is related to the overarching theme, which is that there's economies that are unable and unwilling to rein in their budget deficits. And there is a lack of willingness in the bond market to absorb what is effectively unfunded spending. And you can see that the British government bond fell by the most since October 2022. Now, those of you who've been with us for 195 episodes, thank you. You'll remember that Liz Truss, one of the last conservative prime ministers, who lasted 45 days. And sorry, little mini segue. There was at one point they were like, "Will Liz Truss last longer than a head of lettuce?" And so one of the newspapers in England literally would take a picture of a head of lettuce and be like, "Okay, day 43, the head of lettuce," and then there was like Liz Truss, and it ended up actually she did not last longer than the head of lettuce, which is actually wild. But all jokes aside, you had a massive sell-off in the bond market, and it spooked both the Labour Party government, obviously the currencies that were affected. And ultimately, there's a view that there's going to be a replacement in the chancellor or the finance minister. And it's just more of the same story that we're seeing in different countries that relate to what I think is going to happen, Steve and Keith, in the fall in Canada.
So what, obviously, if you want some good humor, follow British stories.
Yeah, they're so mean. Honestly, they're so mean. The newspapers are brutal.
Yeah.
So Rich, you're referring to the fall budget in Canada once they return.
Yeah. Well, you can see what's happening I talked about it in my IceCap Canadian market wrap, which is the expectations for cuts are slowly being priced out. And I think it's to do with the fact that, yes, inflation is sticky, but again, it relates this idea that they're going to just run a humongous budget deficit, unfunded. Who knows if it's going to be productive of spending or not, Keith? But the point is there going to be enough market participants? Is there going to be enough market appetite to absorb this enormous debt issuance? And lo and behold, you can see that the interest rate, the yield curve, right, which is effectively the interest rate expectations for government bonds, is not falling, it would be signaling cuts. It's actually starting to creep higher and higher, and the percentage of BOC cuts is starting to fall, meaning that that the bond market is not happy, or is kind of telling you what they're not going to be happy about, if that makes sense.
It's kind of, we sort of have our own Rachel from accounts version over here in Canada. But and again, just to be clear, we have not the books that have been closed on 2024 for Ottawa have not been revealed publicly, correct?
Mhm.
I would imagine if they were awesome numbers, they would have been revealed.
Right.
I expect, and we'll probably be wrong with the numbers, but I bet you the budget deficit is 60 to 70 billion or even more in that range. I also expect the new budget when it comes out in the fall, I think it's going to be over 100. It'll be now they're going to paint in a way that it's going to show it as balanced, of course, because they're going to try to separate the data between capital and
Ridiculous.
operating accounts. But the point is that, the Brits had this moment yesterday.
Mhm.
Maybe Canada would have had the same moment back in the fall if they actually had the data come out. Or, maybe it's our turn in the fall and we see it again. But the bond markets for the first time in our lifetimes, because we haven't witnessed it before, that they really are quite fragile right now. They don't want to see what's happening.
Right.
And I think we did say here on the show that you don't want Canada to be number one in this situation, and I think we did say it might be the Brits the first, and obviously the Brits did crack a little bit yesterday. But again, like we had talked about, hey, has the trend changed? Is this the same path we continue to go on? And based on what happened in Britain yesterday, this has not changed. And then plus, Steve, as you mentioned, with the big and beautiful budget by the Americans, we're going to have a similar Canadian version, and everyone is going to do it. So that's we are set up, I think, for some rock and roll in the fall.
So you kind of round this all out. You have a situation where everything is sort of coming to a head, right? Which is all this government spending. The deficits are blowing out across the world, and everyone's looking to sort of ramp up growth. And it's kind of like, well, how are we going to do that? And Rich, obviously in Canada, the thing that stands out the most is you have to get productivity up for starters. But like you're like, okay, well, we've driven all of our growth in the last 5-10 years. It's been a real estate denominated economy. Clearly that is so far in the rear view mirror, and there's no restarting that engine anytime soon. And so you have to kind of go back to what makes Canada a great and prosperous country, which is our vast array of natural resources. And so I think the Carney government, it seems like, is starting to figure that out. But this is also a scenario that's playing out in other parts of the world. We've talked about Germany, of course, where I think that a lot of these sort of governments in an era of zero interest rate policy have been able to sort of ramp up this sort of green energy, solar panels, wind farms. Everybody feels good because there really hasn't been any issues. And we kind of talked about it offline, but like it seems like this net zero stuff is really just a function of zero interest rate policy.
Yeah, I mean, Germany is a weird one, right? Because people would disagree and say, well, if it wasn't for the war in Ukraine, then Germany would Nord Stream 2 would be working, and they'd be able to, import millions and more billions of cubic feet of natural gas. I mean, but that's the point, right? And the point is that, a lot of these policies were designed for a world with no stressors. And those stressors can come from low interest rates to moving to high interest rates. That's a stressor. Literally war. That's obviously a stressor. A change in the populist sentiment towards immigration. I would argue that's a stressor. Whether you like it or not, irrelevant. That is a stressor. There's some delta there. And so in a sense, Germany's faced a couple of these at the same time. And that's why I think we're seeing some delicious walkbacks on lots of these policies. The most recent of which was they have basically greenlit, greenlit a offshore drilling of natural gas, which expects to be able to pump the equivalent of 15% of its natural gas consumption for a particular year. I mean, that is an incredible change in in sort of policy, in ethos, in like sort of philosophical direction of what Germany wants to do. Now, make no mistake, they are not at all getting rid of their sort of overarching anti-nuclear stance, although there's been some rumblings about that. They still think they can do everything via renewable energy. But it is a sea change with respect to, just basically now they're digging holes in the ground again to get in my view, which is ample natural resources really at their fingertips. And I think we'll see that we are seeing that in Canada, thankfully. And we're seeing that sort of, in my view, all over the place where, ideology and reality sort of hit each other and, reality is sort of undefeated. But yeah, Steve, I think it's just another one of these things. It's a theme that we've touched on many, many, many times. It's nice to see that we're right. It's another point for the Loonie Hour.
If you need growth for your populace and, you're worried about people getting fed and again, Trump said you got to run the economy hotter than you want to, you need cheap energy to do that.
Of course you do. Of course you do. Sorry,
the transition to the green energy space, it's very expensive.
It's not only expensive,
it's going to take time.
It's going to take so a couple of things we were lied to about. One is that it was costless and painless. And number two, that you could live your life, and I mean live my life, like the industry would basically be able to absorb this change without having any difficulties with respect to margins, etc. So if you're Germany, you take great engineering, you add cheap energy from Russia or other places, and you export products that people want. And so Germany, as an example, is getting killed from China from the engineering perspective. They're getting killed from Russia and, from renewables from the cheap energy perspective. And people's tastes as a function of that have changed. And Germany's been very slow to react. And frankly, I've been, in my view, very, very dogmatic. And so in the UK, it's a similar situation. The FT had a chart last year about the highest industrial energy prices. And at the top of the table was UK and then Germany, not orders of magnitude, but like 2 or 3 or 4 times as expensive as in Canada, for example, or in China, which still uses 60% of it gets 60% of their electricity from coal, which is in absolute terms continues to rise. And so I think that all these, because you have higher interest rates, you've had a populist sentiment shift, all these things are just creating changes in this economic landscape that politicians are being forced to react to. And I think one of the telltale signs of that is Germany agreeing to drill for natural gas. We're going to talk about British Columbia and, their first cargo of liquefied natural gas and that kind of thing.
Rich, just to add to that, I'm not sure if you saw the news this year. I think it was actually just today, but so the European lawmakers recently agreed to exempt 90% of companies from the carbon border adjustment mechanism called CBAM.
Is that real? Are you sure that's right?
Yeah. It's the decision coincides with economic strain in the EU, including over 1,200 German company bankruptcies in the past 6 months due to high energy costs following the 2022 Nord Stream pipeline sabotage. So the carbon border adjustment it's a policy introduced by the European Union as part of its European Green Deal to address carbon leakage and promote a level playing field for European industries in the global market. And this is something that Carney has also talked about. I think he's been one of the largest advocates for it.
Yeah, he ran the organization that wanted to strangle all fossil fuel industries of capital. Let's never, ever, ever forget that. But yeah, it's just a shame because, in 100 or 200 years, I think we probably will be off of fossil fuels. Nuclear power, I think, will be the largest contributor of that change. But it's just amazing how, before you get to from point A to point B, there's a lot of incremental steps. And I think that they took it for granted that all these policies would just be easily absorbed and accepted. And part of that is what you said, Steve, which is super low interest rates and a fake price of money, basically. But so that's my rant for today. But anyways,
Homer?
I think Rich's rant was you lost energy at the end.
Well, I didn't know if I should keep going or not. I can.
No, you had some good ones over the years, but so the interesting thing with this, it seems like the the blank change conversation that we're not allowed to have on the YouTube, it seems to be weakened with policy changes even over the last 5 or 7 days, and then over the last 2 years, really. And I think that's a good move. I think that's going to help economies recover or transition faster than what they were trying to do. So that's a positive from this. But to have it taking place in Germany, which would have been the epicenter for a lot of these policies, it's kind of interesting, and it should open your eyes. So whereas the rest of the world has employment growth over the last 3 years, Germany has probably lost about 200,000 jobs since 21, 22.
Yeah.
And I think this year they're on track to lose another 100,000 or so. So they are desperate. They have to make a dramatic change with how they're running their economy. So, obviously we talked earlier about governments are making decisions now to, hey, what wasn't working in the past, let's try something a little bit different. Germany's going to try something different. So we'll see
And
how
Keith,
it works for them.
it's also a response to the political pressure that they're feeling. We haven't talked about the AfD, which is the Alternative for Deutschland, which I get that they have a pretty bad reputation, but be that as it may, they've made it clear that Germany should move away from a lot of these climate goals, should stop committing, harikari, economic self-suicide, or sorry, self-disembowelment, self-sabotage, excuse me. And so in order to sort of take a little bit of the piss and vinegar out of that right-wing populist movement, the other parties in Germany have just had to listen. And I would argue that that's sort of what's happening for Canada. You've got a right-wing populist in the US who's saying, drill, baby, drill. Let's open those mines. Let's start exploiting our natural resources. And in Canada, you had a credible threat by the opposition who was, in my view, at the forefront of all of these things. Let's give credit where it's due. And Mark Carney, in order to basically survive as a political actor, has had to tack right and say, okay, just kidding. We do actually like oil and gas and natural gas, and there is a business case, for fuck's sake, and et cetera, et cetera. And so it's
Rich. Well, yeah, I mean that's such a good point, right? I mean, I said this out on Twitter like this week, and in the past few months, the Liberal government's now effectively has rescinded the carbon tax, the capital gains tax, and the digital services tax.
Hooray!
So I was kind of laughing because, ironically, it seems like Trump has actually saved the Canadian taxpayer more money.
Careful now, we're gonna get tomatoes
than any
thrown
domestic
at us.
politician has, right? But none of this, not in my opinion, none of this happens. Again, you can hate Donald Trump as much as you want. I'm not a proponent of him. But because of the political shift in the United States, it's forced all of these governments around the world to also shift their policies as well. And so, again, 6 months ago, the Liberal government in Canada was telling us that we needed all of these taxes.
And we needed pipelines.
Yeah, we needed the carbon tax. We needed the increased capital gains tax. We needed the digital services tax. And all of them have been abolished or rescinded in the past few months.
You're trying to give Trump credit for that? No. That was the Liberal Party. They cut the taxes. They cut the new. Right. They did it. They also instituted them to start with. But back to Germany, I think one very important observation for everyone to appreciate what they're experiencing that we haven't really experienced it here is that as long as you have a job, you work hard all day, you get paid, you go home, you have dinner with your family, and everyone's fat and happy. The moment you lose your job, that's when you go to the town square with your pitchfork. That's when you get ticked off. So in Germany, there are job losses. You're getting entire towns are being wiped out because of this shift from the automobile industry from gas focused to EV, and China's eating their lunch on it. That's why the AfD is popular, and the other parties are saying, oh wait, we need to make a change here. So again, in Canada, if we get job losses coming up, politically someone pays for it. That's what will happen. So
I think
that's what we'll continue to watch.
It's a good point. It's the same thing in Canada. I mean, look at how much the conversation has pivoted towards immigration. I mean, it was always like Canada's pro-immigration. We love immigration. We need more of it.
and now it's turned into, hey, listen, youth unemployment's the highest in 2 decades. You can't afford your rents anymore. People have pivoted. The labor market there's some excess slack there, and clearly now you've seen population growth go to zero because governments again have been forced, I think, through the dismay of the working class, which Rich has so eloquently, touched on.
But it's the dose makes the poison. And I think that's often what we forget. Like low interest rates are good. Well, if you keep them low forever, that's bad. Renewable energy, probably good. If you obsess over it and ban all other forms, that's bad. Immigration is probably good. If you triple your population growth exclusively via immigration, that's bad. And I think that the problem that a lot of these governments had is that they've just been either full board on these, in my view, left-wing populist ideals, and they have not at all been nuanced. They have not been thoughtful in these policies. You know what I mean? Like, in 100 years, probably solar and renewables might very well be the dominant form of electricity. And, great, that'd be fantastic, fine. But from here to there is a really important point. But like on this digital service tax, I want to give Carney credit because there's lots of people saying knees down and blah, 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 and all this shit. I'm like, we can't criticize the guy when he does something dumb and then not give him credit when he does something right. Like the digital service tax was a stupid idea from the beginning. A friend of the show and former guest, Michael Geist, who's a professor of law at University of Ottawa, has written extensively on this. They were warned last year about how stupid an idea it was. They were when Joe Biden was, expected to win the election, or the corpse of Joe Biden was expected to win the election. People were worried about, the Canadians were worried about there was be some retaliation. This was very well documented, not only in committee, but in the debates in the House of Parliament and by experts by Geist. And of course, the Liberal Party in their infinite wisdom jammed it down the throat despite everybody's protestation. So I'm going to give Carney credit that he didn't say like, oh, we need to keep doing these. Like, all right, give Donald Trump a win, which was a win for Canadians anyway, because we would have paid the tax, if not these corporations. And the reason that is because these products are highly inelastic. We're all addicted to Twitter and Instagram and Facebook. And when a product demand is highly inelastic, it means that those companies can pass on those costs and we will happily pay for them because we're all addicted to freaking Instagram. Ergo, Carney did the right decision in just walking away from that. Now, you could argue it was a bad negotiating tactic. That's a different thing. But I think we should just give him a break on this one.
I'm okay with that.
I'm not.
You want to pay higher taxes, Keith?
First of all, I only have one of the three. I have the Twitter. I don't have the other two that you mentioned. No, what I mean by that is, so you're making the assumption that he's been completely disconnected from all the previous policies that were implemented or advised and suggested. And I'm hopefully I'm wrong with it. I think the world, the West, was really leaning towards this one world government in terms of not necessarily, there's one person running everything, but you have to admit in the Western world over the last decade, there's been some very similar themes with a lot of different parts of how to run our countries. And this digital tax is one of them. The Europeans have gone full on with it. Canada went full on with it. The Americans tried to swim in that world a little bit and it got shut down, of course. But it's just my expectation that the current prime minister, he was involved at different levels in that world where a lot of these policies were available. I'd love to see something from him in the past come out to say, actually, I had an interview here and I thought it was a bad idea. Suggested they shouldn't do it. Or maybe he was in the back rooms involved with this and said, hey, this was a bad idea. But again, a lot of the current actors in Ottawa today, they're the same actors that were there before. So once again, it's a great, it shouldn't be a tax. Absolutely.
Of course not. And just so people understand about the revenue, sorry, Keith, but just so people contextualize this, Canada's government generates about $470 billion in revenue per year. And this digital service tax was going to generate gros max, if you could agree for all these international companies to pay it, maybe 1.5 billion per year.
Oh, I thought it was more than that. Are you sure?
No, over a 7-year period, it was like 7 billion. I can find it. I have it in front of me. I can Google it. But if I made a mistake, I'm sorry. But the point is that it's not very much money. It was very much an antagonist. They were trying to antagonize these massive digital companies. I mean, that's
Rich, it wasn't a tax to collect money, Rich. It's a tax to control your thoughts.
I mean, that's happening.
They want to control what you get to see and not see. You too, Steve.
As you,
Especially you.
Well, as we get closer to wrapping up this, Rich, do you want to chat anything on U.S. jobs data, or you want to skip that?
Sure. Well, I mean, okay, so I'm just so you know, I was right. So it was 1.2 billion per year, roughly. Just so you know. Anyway,
smarter than I thought.
No, I just Google it. Just go if you don't trust me, guys. Just go on the PBO, which is the Parliamentary Budget Office, and they have a whole.
So, Rich, if the tax was in place, you wouldn't be able to Google it. You have to CBC it.
Anyway,
you still can't get a lot of news, by the way, on like Facebook and Instagram.
Yeah,
I mean, I don't use that one.
Sorry,
I don't use that one. I don't have.
Well, then you're doing all right then. But
go ahead,
Rich,
sorry.
you were chatting on we've kind of talked about the outlook for the Fed. Yeah, the expectations from markets, governments running the economy hot. Obviously, a lot of this depends on the economic data. We had the U.S. jobs data that came out today. Obviously, markets are paying close attention to that as the Fed has a dual mandate to support the labor market. What was your takeaway on that?
Well, I mean, it was better than expected. So I think the expectations were about 110, if I'm not mistaken.
110,000 jobs added.
Yeah, exactly. And I think the U.S. non-farm payrolls came in 147,000, which is much better than expected. Remember, people, it's expectations relative to reality. But but there's under the hood, there's a couple of positives and a couple of negatives. Number one, a lion's share of those jobs were government jobs. Now, it was not my friend who's a commie, he'll know if he's listening. He said, oh, that's because Doge is away and Donald Trump has had to walk back the federal government cuts. That's actually not true. Most of the government jobs in America are state and local. Only a fraction of them are federal. And out of the 147,000, 73,000 were government jobs. I put the chart on Twitter. You guys can find it. So that's, I'd say, one of the bad things. On the positive things, you had a really big contribution from construction. And remember, construction has been really, really weak in the United States. Both the National Association of Home Builders is at a COVID low. So that's an index of home builder sort of appetite and a barometer of or sentiment index. And that's a really, really important indicator in America. Just like in Canada, construction is a big employer. But then on the positive side, you had an unemployment rate that dropped dramatically. It was more than expected, to 4.1. So the average work week. So it was like a mixed, I would say arguably it's quite mixed. But if you include that with a decent manufacturing ISM, my favorite, diffusion index, and then today another positive from the non-manufacturing ISM, which is back above 50. Remember, manufacturing is about 25% of the US economy and non-manufacturing or services about 75. So this is a significant chunk of the economy that actually did relatively well. And if you look at the components, again, more of them were positive than negative. That is to say that, the weakness that I think we are guilty of expecting in the US economy hasn't really come through. You tack on the deal that happened in Vietnam, which is a conduit for Chinese exports, and Chinese deal that's coming through with the equity market at all-time highs. It's good news for the U.S. economy that we were not expecting.
So potentially no recession, big, beautiful bill, fiscal bazooka, and rates getting cut by 100 basis points, maybe more, at least expected. Seems bullish for risk assets.
Yeah.
We'll see.
Well, the jobs number suggests that maybe they won't be cutting as soon. Yeah, that was the key thing with it.
Unless, of
course.
Guys,
that's a good, Steve, you thought this was going to be a snoozer of a week. Canada Day, July 4th stuck in there and everything.
Remember, in May he gets to hand pick whoever he wants. So
Yeah.
We'll see how much autonomy the Fed actually has.
Yeah. If I was
Mr.
Powell,
President, if you're listening, I would cut rates to -500. Hire me.
did we talk about
How often do you think Carney talks to Tiff Macklem? Those guys used to work together
all the time?
Oh, all the time.
Guy
They
doesn't
have
a
an
budget.
Instagram account together. They're going back and forth.
DMing.
Oh man.
I have a DM as well. I have a Twitter and a DM. 2.
Wait, what?
If you have questions or comments, send Keith a DM on Instagram. All right. It's a good place to wrap it up.
Keith needs to go to the club. A drink is waiting for him with all of his friends there.
How many push-ups did you do today, Boomer?
Oh, I'm up to an aggregate level or a single push? Single
No,
set?
you got to do. You do. I'm assuming you do them consecutively.
Oh yeah.
How many?
I can do my age now, so that's
Yeah, right.
75.
No way.
Hey, Rich was there for that infamous pull-up
Okay.
experience.
Rich,
You
how
were
many
there.
was it again?
He did 17. He actually genuinely did 17 pull-ups. I was very impressed.
You never
Thanks,
cease to
man.
amaze me.
Yeah. Anyway,
Thanks,
there
man.
you go.
All right.
Okay, guys.
As always,
that's
guys,
it.
appreciate the support. This has been a pleasure. If you enjoyed this episode, share it with one friend, family member. Help us continue to build the Loonie Hour community. And as always, we'll see you next week.